Hey guys, it's Thanos here. Today I'm very excited because it's the first time we're gonna talk about individual stocks. I'm gonna show you three stocks that I recently bought and I believe that is a great opportunity to invest in them right now because of the beating they all had during the previous months. So stay tuned through this whole video because I will give you a full analysis of these picks, why I believe they should be in every portfolio for the long run, and of course how much money I have invested in them. So let's do this. Okay, the first one is Etsy. The company provides an online e-commerce platform where creators of arts and crafts, vintage items and other unique goods go and sell their products. As things turned out, Etsy was a big beneficiary of the pandemic because stuck-at-home shoppers turned to Etsy and other online retailers like Amazon and Walmart for both essential and non-essential items. In their last earnings call, Etsy toppled expectations. The company reported adjusted earnings of $1 a share versus estimates of 88 cents and compared with 10 cents in the year-ago period. Revenue soared 141% to $550 million, the fourth quarter in a row for triple-digit gains. Now, gross merchandise sales, which is the total value of goods sold through its website, soared 132% to $3.1 billion, above the higher end of guidance. However, the stock plunged 15% in reaction to all of these numbers. Why? Because Etsy said it expected growth in gross merchandise sales to slow to a range of 5% to 15% in the second quarter and revenue growth in the range of 15 to 25%. That, compared with triple-digit growth in the previous four quarters, was a bummer for investors. Right now, it trades at about $164, and since its share price hit an all-time closing high of $244 back in March, the stock has tumbled around 30%. Now, despite all of this, I strongly believe Etsy is a great stock to buy, and this is for three reasons. So, first of all, Etsy's brand power is increasing in a massive e-commerce market. The company estimates the total market opportunity is at 1.7 trillion, but the company's GMS in 2020 was just 10.3 billion. With GMS growth accelerating more than 100%, it's clear to me that Etsy is still scratching the surface of the opportunity in its home market. Now, most marketplaces fail to get off the ground, which makes Etsy's success even more impressive. A new entrant might attract sellers, but there are not enough buyers, and vice versa. It's also tougher to expand overseas, where relying on exporting and importing between countries causes slower delivery times, which can then in turn dampen engagement. But Etsy is gaining serious ground in the UK and Germany, which are two large international markets. The share of domestic sales is now over 50% of total GMS in each market, which shows these markets establishing a vibrant local marketplace. Total GMS in the UK soared 189% year over year in the fourth quarter, while Germany saw GMS increase by 109%. As Etsy penetrates different markets around the world, it is further separating itself from the shopping experience at mass retailers. Now, because Etsy offers a dynamic marketplace of sellers with unique items for sale, the marketplace can easily adapt to the tastes of different cultures all over the world. Also, Etsy is now a top 5 e-commerce site in the UK according to Comscore. During the pandemic, they started to see the domestic share of sales increase in other international markets, where the domestic threshold was still less than 50%. They have a powerful competitive advantage built around a wide selection of unique items, but it's still in its infancy as a global e-commerce platform. Also, Etsy has momentum. While management's guidance points to recent growth trends continuing through the first quarters of 2021, growth is expected to decelerate starting in the second quarter. The expected slowdown is based on e-commerce projections from third-party research data management referenced during the fourth quarter earnings call. Still, a near-term deceleration would only overshadow an incredible growth story. Etsy was posting terrific numbers before the pandemic, with GMS increasing by 26% and revenue up 35% in 2019. Those growth rates serve as a useful guide for what to expect beyond the pandemic, and it's all Etsy needs to maintain to deliver handsome gains for investors. Moreover, their price to free cash flow multiple of 29 looks relatively low for a company that offers great long-term growth prospects, especially compared to Amazon's valuation. Even though the share price has rocketed 237% over the last year, the valuation is not that high for a company that it's just starting to hit its stride in large international markets, and it's still in the early stages of penetrating the US e-commerce market. I strongly believe that Etsy is simply one of the best e-commerce stocks to own for the long haul. Now, to go into numbers, as you can see, for Etsy, I have invested 5,210, which is about 39 shares. And in order to get a better perspective, that is about 2.5% of my whole portfolio. I believe that this is enough for the moment unless we see another dip where I will be tempted to buy some more. Now, before we go into the next one, please consider subscribing to the channel and click that thumbs up button so you can see more videos like this one. It would mean a lot to me and thank you very much in advance. Okay, the second one is Pins. Pinterest is trading at a forward price to sales ratio of 20 in the middle of the pack of its competitors in the social media space. The price to sales ratio can be one of the most informative ratios to consider when comparing companies that may not be profitable. The stock is down by over 25% in the last 60 days. The sell-off was in response to management guiding flat user growth in the US next quarter. Investors are concerned that as people return to pre-pandemic habits, Pinterest may not be able to command the growing user base as it did during the lockdown. Indeed, management acknowledged this headwind and is expecting engagement on its site to moderate as folks are less restricted in their outdoor activities. Still, this is more of a short-term issue as those following the stock didn't expect elevated levels of engagement to last when people had more options with their time. So why Pins? Over the long run, Pinterest could add tens of millions or even hundreds of millions of new users to its platform. Pinterest said it had 478 million monthly active users in its most recent quarterly report, up by 30% from last year. More than 75% of users are outside of the US, although the majority of its revenue is domestic. Still, there is room to grow. Facebook has a total of 2.85 billion monthly active users. I mean, let's be realistic here. People like social media apps. They are free to download and sign up and come with cool features. Pinterest allows users to browse through inspiring images and pin them to personal boards for viewing later. Its first quarter revenue soared 78% from the year-ago period to $485 million. That was its best quarterly growth in 3 years and beat expectations of $472 million. Adjusted earnings also topped estimates. Pinterest said it expects second quarter revenue to jump 105%, also topping expectations. Pinterest is also an attractive venue for advertisers, the source of all its revenue. It does not take a cut of the sales made through its site. Moreover, it also provides a platform for businesses to build their brands and drive sales. Actually, the company is not as far along in fully monetizing its user base like Facebook. In its quarter one statement, Pinterest generated an average revenue per user or ARPU of $1.04, while Facebook's ARPU was $9.27. Pinterest only recently began monetizing users in its first Latin American country, hello Brazil, and began monetizing Mexico's user activities in May. As it builds out its products for marketeers in more regions with more capabilities, its ARPU can get closer to Facebook's. Already, Pinterest is closing the gap. For example, while Facebook grew revenue by 48% in the most recent quarter, Pinterest increased it by 78%. Similarly, while Facebook expects to grow revenue near 50% in the second quarter, Pinterest expects over 100%. Okay, now Facebook is an excellent company that has made shareholders wealthier. In Pinterest, however, I see a younger Facebook built on a better foundation, and by that I mean the positive content, that has the potential to increase wealth over the long run. For this stock, I have invested 3,151, which is around 61 shares. Again, this is probably about 1.6% of my portfolio, and I want to slowly increase my position in the future. The last one I want to talk about is an ETF, and particularly TAN ETF. Clean energy, with its various forms, has been a hot investing area lately due to the global push for going green. In the United States, President Biden is voicing for clean energy transition with an optimistic goal. China's president recently reiterated his vows to turn his country carbon neutral by 2060. China will start tapering coal usage from 2026, and Europe's efforts to become a green continent is also pretty prevalent. It's true that the solar industry has been under heavy pressure recently due to the supply crunch in global chips. A global shortage of semiconductors to auto and electronics makers is now hitting the solar stocks, sparking concerns over the company's abilities to meet the record demand. In this recent rate move, TAN sold off 35% before rallying 10% these past 2 weeks as yield stabilized, and then fell again as yields made another move higher. And as if this was not enough, US Treasury Secretary Janet Yellen cautioned on May 4th that interest rates may need to rise over time to keep the US economy from overheating, intensifying a sell-off in growth stocks. However, Yellen elucidated her remarks later on, saying that higher rates are not what she is predicting or recommending. As a sector that experienced significant appreciation during the course of the pandemic, a period of consolidation and profit-taking was expected and is healthy for the long-term trajectory of the industry. This period of volatility is when you have to ignore your emotions, think about clear long-term trends, and set up tactical allocations at discounted prices to take advantage of those trends. Elevated volatility will be with us for at least the next 12 to 18 months as we gain more visibility into the economic recovery. These are periods in which long-term investors should be focusing on increasing exposure to long-term growth trends with real insight into profitability. Here you can see the top 10 holdings in this ETF. These 4 top holdings make up for around 35% of the ETF's holdings, thus offering a pretty concentrated strategy in the solar market. This composition should offer elevated returns as it offers a nice blend of exposure to profitability and real income streams, and also a hedge against price hikes and constraints on supply, which I believe would hurt the installer models the most. Now, let's take a look into some individual quarterly reports. First, Solar reported better than expected earnings. Earnings per share of $1.96 beat the consensus estimate and improved 130% from the year-ago earnings. Revenues climbed 51% year-over-year to $803 million and edged past the estimate of $695 million. The stock occupies the 4th position with 6.4% of assets. Enphase Energy reported adjusted earnings of 56 cents per share, which surpassed the consensus estimate of 41 cents and increased 47% from the year-ago earnings of 38 cents. Revenues also soared 105% year-over-year to $301.8 million. The company takes the top spot, accounting for a 9.3% share in the funds basket. Now, SolarEdge Technologies reported mixed results. It posted earnings of 98 cents per share, improving 3% from the year-ago earnings. Revenues said 6% year-over-year to $405 million and came well ahead of the consensus mark of $96 million. SolarEdge takes the second spot with 9% allocation. With many analysts believing that the supply crunch in semiconductors will be prolonged, I expect some more margin pressure in the cards for the solar stocks. I mean, we could see further sell-offs in the space ahead, but once the correction is done in the space, one can take advantage of the buy the dip strategy. The fundamentals are strong for the space. The cost of renewable energy generation has been falling in recent years with continued technological innovation. Increasing global acceptance has also been favoriting the space. Biden's push for clean energy and infrastructure plans will continue to fuel growth in the space. The president plans to pump $2 trillion into green energy over 4 years to build solar panels, charging stations and more, and aims for the net zero emissions by 2050. Additionally, the recent 2-year extension of the investment tax credit will drive greater solar adoption through 2025. So overall, TAN is an excellent ETF if you want to get exposure to solar and wind energy. The ETF's construction methodology, diversification, and fees are compelling. And indeed, I believe that the underlying investment thesis for this ETF is valid and will likely play out as expected for the next 5 to 10 years. In TAN, I have right now little over 1,000 invested. I know this is the smaller position of the three so far, but that is only because I need to wait to transfer some more money into my account. Maybe I will show you that again in another video, but I want to make it around 4% of my portfolio, which would be around 8,000. Okay guys, these are my picks for this month. So why won't you let me know in the comments below which are your favorite stocks right now? I hope you have a great weekend. See you next Friday. Bye bye.